Hello, friends. How are you today? Hope you're doing well. Welcome to Financial Literacy Made Easy program. In this program, we will learn about how to be wealthy and passive income through smart investments. In today's topic, we're going to learn about what is tax, what are the four quadrants of income, what is active and passive income, and smart investments. I'm going to go through the assignments end of the topic. Taxes, about the taxes, I'm going to go through only the high level of tax just to understand for the investors, what are the taxes we pay and how to minimize our taxes, and what are the income streams. And with that income streams, we have to pay tax. So just a bit of understanding where we paying the taxes so you can save some tax on it. Let us go to the types of income taxes first. So, tax is collected by the federal government through tax department in any country. For instance, in Australia, it is the Australian Taxation Office, which is we call ATO. Let's go through the different kinds of taxes, where there are direct taxes or payroll taxes. So a direct tax, the tax that you directly pay to the government, in the sense, in the form of wages, salaries. When you work, you get tax deducted through PAYG, pay as you go. So they are the direct taxes, for example. So a salary person pays direct tax, and then there's indirect taxes which we pay is the uh, through GST, like goods and service tax. When we purchase any goods from the stores, like groceries, vegetables, products, paid to professionals, they charge us GST. So that GST is indirect taxes. And then we have corporate income tax. These are the taxes paid by the companies. And the superannuation taxes. So superannuation is a pension program. Every country has a different name. In India, I know we call it as a provident fund. In Australia, we call it superannuation. And this is like a superannuation fund is formed by contribution from the employer, basically, if they're employed with somebody. Otherwise, self-managed super also can be done. Like mostly self-employed does this, or business people does it. And we have excise tax. Most excise tax on these, alcohol, petrol, like fuel, cigarettes, all stuff. So they charge excise tax on it. And then there are the property tax and tax on inheritance, which we hold. If you hold any property, like property taxes are primarily levied on immovable properties like land or buildings, any other resources. For example, is if you own a property, either it could be investment or principal property, you pay rates on it. So this is the form of tax you pay. And inheritance tax acquired from a deceased person, like from your ancestors' property. So what is a tax actually? Let's see that. Um, what do what does the government does with our tax money which they collected from different types of taxes? So what they do is these taxes are used to run the country. For example, say we all pay money or taxes, and these taxes are put into like budget of the country, and then budget is allocated, divided into different, allocated to different sectors, like for countries development, such as defense, could be infrastructure, education, bridges, building bridges, giving pensions and all stuff. So these are the money where the tax money is going to. Let us go to the next topic, is the cash flow quadrants. So the cash flow quadrants is about the like what are the income we generate. The country generates, like there are four types of income sources in general falls into. One is the tax is collected through employees, which is what they're working on, like in like on PAYG. And the other form of income source for the people is self-employed people, like trade people, professionals, so these are the people like sole traders they call, who run on the ABN, taxi drivers. These are all people comes under self-employed, so they also have to pay taxes on it. And then we have a business people who run the business, so we know the business people, they also pay taxes. Another quadrant is investors who invest money on the any business, or shares, properties. So those are passive income group. But we have to see how much they pay. Like employee pays up to like around 40% tax, and small businesses like they pay up to like 40 to 60%. They say it depends on which country we are and what's the tax brackets. And then business also pay, but this they pay like 20%. These are just comparison between who's paying how much. And then investors may not pay at all. It's like they're rich people, they're 0%. So this is the intention of this is to encourage you to go invest money in passive incomes and you pay less tax on it. So there's a different structures how you pay less tax or zero tax in the investment point of view. So this is to know only the quadrants are only to understand the how much tax each person pays. um, so we have discussed already quadrants in previous sessions, and this is how the tax paying, like say if somebody or employee and without any assets or liabilities, so we saw they just earn some salary and next they pay the bills, that's it, they are the poor people. I'm not talking about the poverty under not poverty, but it's about the poor strategy. I'm talking at the financial point of view. And they're middle class family, yes, they have a house, they pay mortgages, they pay school fees, they have a family, and then they have expenses like loans, credit cards, personal loans. They are the middle class families. But assets in the men's, which is giving income to us. The principal home is not an asset; it's a liability, which we already discussed. And the rich people are the one who earn income through assets. There's a various streams, income streams they have, and then the expenses and liabilities paid in the tax before they get income. That like all the they pay on the company base like for the tax benefits. So they show in a different, they're in different structures. So we talk about that more in detail in future sessions. Let's discuss about active income and passive income with the examples. So, what is active income? Active income is nothing but we directly earning like through wages or self-employed. Either quadrant one and quadrant two. Quadrant one is employee, and quadrant two is self-employed. So these people earn active income. Even business people also do active income, but they'll be also taking salary from their business. So that becomes they also employ of their own business. So this active income is what generate hourly based, weekly, monthly, or salary. What are the salary we get it. So we get the active income, which for that we need to be physically present at that place. And it's a short term like payment, right? It comes quickly. But passive income is a one, it comes very slow, and we you don't need to have a physical presence there. And you need to no need to spend that much time. Only the time you spend is to monitor your money, where his account is, where your money is, how is your money performing, and track of. That's all you need. So that's a passive income. And like for instance, if you have a rental property where you get a rent, so you need to, that's a passive income, right? Stock market at the same time, and some getting dividends or not, all this stuff. So these are the things you get the passive income through. And this is not a short term period, it's going to be a long term period. For instance, say example I given a passive income and active income, a comparison between two partners. Say there's a restaurant, and say called any restaurant you take up, and in that restaurant there's an investor and there's an employee working for him. So investors, what did they just put the investment there, and then the involvement is not much or very minimal in that business. But the employee, say I took the Charlie as investor and Kim as an employee. So employee works on the salary base, and looks after, like he could be a manager as example, he looks after all the management of the business, runs the business for him, and he takes a salary. And then Charlie, he gets the return of investments. So that is the difference between an active and passive income. Let's go through the next one. So, what are the passive income streams? There are several passive income streams. I've just listed a few of them. There are like interest on incomes, such as your savings, like bank deposits, FDs in banks, bonds, securities. Any other like any guaranteed investment contracts if we have anything, such as treasury bonds and other things, right? And then stock dividend, you get dividends on the stocks, and stock also price goes up. That's one kind of a thing. There are mutual funds, and mutual fund you have systematic investment planning as well. There's a long term passive income. And you earn in a real estate, p2p lending, which is also an interest to lending to the third party, higher rate of interest. And you can be a silent partner, like investor, just invest in a business and just get your share in returns of investment. And also this, like these days technology has gone up, so use the technology to do your content in the YouTube, and then monetize the your programs in that. And online courses, which is like teaching in online, so that's also very good. And also you have a write and publish a book, which is very good. Actually, you get a royalty on the books if you write and publish, if it's doing well. And any other affiliated marketing reseller programs, there are a lot of things and you can have a big list of it. Let's see what is like passive income and active income comparable. Say for example, passive income is I just don't go through all of it, but you have to just go through it thoroughly, the important points. Um, so it's like you just have less time. So definition can be earned with little or no effort and without material participation. That's a passive income. And individuals become their own bosses. In active income, there's a requirement of physical involvement and material participation there. And individual work under a boss to whom they report. So this always you work under somebody. So, and also passive income, it serves as a supplementary to regular income. But an active income provides resources for passive revenue. And then consistency. Let's see, the passive income can take months or years to acclimate and might not be consistent as well. But active income is quicker and ensures regular income streams. So that means if you got a job, you get paid. But in passive incomes, if you invest in stock, there'll be a loss in the stock or down. So depends on what time you invest in, what time, and what time you're withdrawing the money. So lifestyle, yes, allows individuals to devote more time and energy to the recreational activities and hobbies. That is what we need. We need to invest somewhere, get some passive income, go for holiday, do whatever you want to do. That's gives more time, still getting income. Who doesn't like the passive income in that case? But in active income, you don't have that leverage, right? And you need to put your physical, and physically you have to be there. You have to sacrifice some hobbies and entertainments, especially if you're in like a industry like a restaurant or a saloon. I've seen my friends who has a hair salon, they didn't end the restaurant business. They didn't see the life in the weekends, because most of the happenings are on weekends. I've been like, I know them from last 10 years. They didn't see the life at all. Socializing life at all. So this is very difficult for them, because they physically they have to be there. Yeah, so the tax benefits, and the most important thing everyone want is the results. What the results? So passive income gives money while you're sleeping, but yeah, in active income now you have to be there. You can't escape. All right, invest in passive income while you have active income. This is very important in topic which I'm going to discuss, how to be a smart investor, because everyone doesn't start the life with the lump sum money in their hand. So, like when you finish your graduation, or while doing graduation, they do most of the people do part time. But let us consider from after they finish the graduation. I took a good example of a person like Joseph. Um, a single person. He has started a full-time job at the age of 21 years. That means he finished his graduation, and his starting pay is around $3,500 per month. And after tax, he's getting tax and expenses. He's saving around $1,000 per month. His savings. Usually, what they do is they spend the money, like youngsters. They spend go out buy cars, weekend spending with the friends, clubbing, all this stuff. So but if you have discipline towards, you can still do that and moderately. But thing is, how we have to be disciplined, because if you have $1,000 in your pocket, you don't have any commitments, so you just spend it. So say if you're working like 40 hours or 5 days a week and weekend is off, so it means you have full time weekend. Now, this Joseph is a smart investor. He's been educated in financial literacy. So, what he does from his savings $1,000, he split like 20% of his investment. He started investing in his share market, because he has been educated in how to invest in shares, how to look at them. So he knows where to invest. So he has a very good fund manager too. So in that case, he started investing 20% of his like $200 from his $1,000. Still, he has $800, and from $800 another 10%, like in $1,000, another $100 he invested in mutual funds. Say he systematic investment plan is one of the plan he has chosen in mutual funds. So where the money is compounding, like every month he put $100 from that. So from $1,000 he has spent already $300 per month. Still he has $700 more, so he can do whatever he want with the $700. But there's a commitment of uh, $300, so 30% of his savings every month. So that's for future, and for his future plans. Like say example, so he's invested 12, and also he say he got $12,000 savings also from his past. So he don't know where to invest, and but he's instead of spending, he is smart enough to invest somewhere which he given by his parents or past savings. So like let's see how his what his returns from his investments. And short-term income, like the 20% he has invested in share market, where he get dividends and like the profits from the shares, and also the share price keep increasing, so he keep monitoring that. Apart from that, 10% at $100 every month, which is put into a mutual fund, or like a sorry SIP, where he gets 12% interest for 10 years. So for next 10 years he is committed to invest $100 on his account. So that's the rate of say 12%, and that could be just more or less. There are up to be SIPs pay up to 25% also per year. So he's earning around through that. But like let us see the long-term one. So $100 invest for 10 years at the rate of 12% per year. He earns $23,000 at the maturity period of the 10th year. So how much he has put together all his $12,000? At the rate of 12%, he got $23,000 in 10 years time, so which is very good for him. At least he can cut down his coffees or something, miscellaneous accounts, but still he's giving more money. Imagine if you get 20%, it will be like $38,000, it's the same amount. And imagine if you invest $300 every month, you'll be getting around $100,000 at the end of 10th year. So if you give for 20%, so this is how you have to investigate how much you get and how long it is. So this is a good exercise. And then he has that $12,000 which his parents gifted, or maybe from his savings together. He just put in the same SIP for 10 years, one time investment, and left for 10 years, and he's getting for $37,000 just for 12%. So imagine if you have 20% return, will be like more than that, like $50 approximately. So this is how the smart investment Joseph has done. So what his result is, by the age of 31, Joseph has earned, for instance, $37,000 plus dividends and equities. So it's a long-term investment and the short-term investment. So he get paid through stocks, exchange, and it's a liquid cash. So he built his portfolio already without changing his lifestyle. So he got short-term goals, long-term goals, and he got enough money for deposit to buy a house. You know, so he might buy a house at that age, and the salary might have already gone up. At 31 age. So Joseph has used his financial literacy education to invest using his skills such as GDP, inflation of a country, and then determine how interest um, to earn using time value money. So how much interest he has to earn. That means if inflation is 8%, he's smart enough to invest, which is more than 8%, that 12% to 20% return of investment for his principal amount. So that is how he uses knowledge for investment purpose. Okay, I think hope you understand this. Do this exercise for your own with your own payslip and play around, and then you'll get some figures out of it. Let's see the quadrants. Quadrant one, we discussed about the employee and self-employed businessman and investors. So let's see the overview of just like how the payslip looks like, how much tax has been deducted, will be deducted for a person. So for instance, say we take the example of St. Joseph is earning say $3,000 a month, like, and he has been paid $1,450. After tax and superannuation, he gets net is 1,331. So that is what he gets the net pay. From that, he has to pay his bills. So he might hardly save around $300 to $400, maybe depends on his habits and what his commitments are. And through that savings, he can invest whatever, like as little as $100 or $50 a fortnight. Also, that's how they say it is. So he's ended up paying around in this. The main reason to show the pay slips is how much these guys are paying tax. So if he earn $3,000 a month, he's approximately paying 23% of the tax. And then we go to a self-employed. A self-employed could be a ABL, like sole trader, a tradee, or could be a professional. So take an example of a self-employed who is um, earning this is an invoice. How they put the invoice? They just give an invoice for the sales services. This just an invoice. Don't worry about too much about it. He charge. This is an example of uh, a water technician. He just installed the water meter in the house, and he charges a bill, and clients being invoiced, which clients pay to him, and he has to charge TST. So end of the year, he's going to file a tax, and that tax returns, which is mostly done through accountant. So for instance, if he earned 154,485 is the total sales he did, and that's income, taxable income. Through that, he deducts all the expenses such as superannuation, vehicle repairs, and all other things. So, and then his expenses 124,988. That's all his expenses to the business. That's how he showed them. And then he got the total taxable amount is 29,497. So he going to pay on 29,497. That's income actually he generate for the year. So for that year, that's the income, and then the tax payable on that is 8,311 is came the figures. So that is nearly 25%, something around of the tax, approximately. That's how much he paid the tax. So initially employed paid around like 22% or 23%, and then self-employed 25% approximately. This is how the difference is. And the businessman, even he pays less actually, but we just ballpark. He just puts sales cost expenses, and he's owner of he's employee of his own business, so he takes his salary as well. So and then he has to pay tax on his salary as well. So, and that's how he get net income. And investors is also, they pay tax, but the different strategy for them. Say they have a revenue of $1 million, and the shares or stocks they sold, the gross profit how much it is, and then they have to pay the interest. They show the expenses, operating expenses. They might have to take loan, and they pay interest on it. Sales, any admin cost, software cost, everything they put it on, and then they get the net income after that everything is taken off. They pay tax. It shows like tax here, but again, from the tax, they show more expenditure in a large corporate way, in a bigger scale, and they make it to zero. There's a different strategy they use. We're going to look at that in later sessions. Okay, now we got to the end of the session. We have a assignment for you. Um, Find out any on the internet. Just Google and find like go and look out for the blue chip company. under Wall Street just person. So just go to their statement, look at their financial statements of a blue chip company, how much tax they're paying. When go to invest like Warren Buffett, go and see how much tax is paid. So we're just looking at the tax point of view, how much tax they're paying. You can go for a smaller company, any of your friends or family members who has business, look at them and investors particular point of view, look at the investment point of view, ask them how much tax they're paying and how much benefit they're getting, how they're working it. It's a good research actually. And also do a research and make a list of passive income streams which you prefer to invest from your savings, also which you are interested in. So sometimes you may be interested in like making reels in the YouTube, Instagram, Facebook, yes, and see that instead of getting that, how you going to how you can monetize those reels actually. So out of your the passion is done, and then your passion is fulfilled as well as you get passive income. So, guys, I'll leave it to with you today, and hopefully you understand just the glance of the taxation part and fourth quadrants especially, and then active and passive income, how to make smart investments. Thank you very much for watching my session today.